Last year, the budget deficit in Ireland exceeded 14% GDP, even before the need to provide additional backup for the country's banks, and substantial deficits are now the norm throughout Europe. As a consequence, public sector debt, already high in many countries before the crisis, is rising strongly. An IMF paper published at the beginning of last month about the sovereign debt position of 23 advanced economies notes that, quote, on average, public debt rose from 60% of GDP on the eve of the crisis in 2007 to almost 75% by the end of 2009. More striking, IMF country teams project debt ratios to continue rising over the next 5 years, averaging more than 85% of GDP by 2015. The same paper notes that the public debt to GDP ratio of the G7 countries averaged 103% in 2009 and is projected to average 118% by 2015. The lowest public debt to GDP ratio in the G7 in 2009 was 68% in the UK, and the highest, 218% in Japan. Another IMF paper estimates the extent to which various governments will need to borrow in 2010 and 2011 relative to their GDP, taking into account both maturing debt and the size of the fiscal deficit. For the US, that figure is estimated at 32% of GDP this year and a further 19% next year. For Japan, it's estimated that the government will need to borrow a gross amount equal to 64% of GDP this year because of very high debt maturities, and a further 41% next year. This means that both governments are highly dependent on investors having continuing confidence in their ability to get debts under control. What is profoundly disturbing is that one of the authors of these IMF papers has observed that the fiscal stimulus packages put in place to combat the worst effects of the crisis account for only 1/10 of the increase in public debt projected for the period from 2008 to 2015. The basic problem is that in many developed countries, structural budget deficits have become deeply entrenched, at least in part because it's now clear that the sustainable path of GDP is rather lower than it appeared to be before the recession. In Japan, debt servicing already absorbs some 35% of all government revenues, and that despite the fact that Japan has been able to borrow at rates of interest which are historically without precedent, currently very close to zero for 2-year money and under 1% for 10-year money. If Japan were faced with paying rates of interest even no higher than those paid by, say, Germany, servicing the Japanese government debt would absorb still more of government's revenues. But if Japan had to pay rates equal to some of the more improvident European countries, the situation would be dire indeed, with very little left to pay for all the other services which the government provides. Late in August, Morgan Stanley analyst Arnaud Marais argued that in assessing the ability of governments to service their debts, it's important to look not just at the level of debt relative to GDP, but also the level of debt relative to government revenues. Using this approach, Spanish government debt is a relatively modest 150% of revenues, British government debt 170%, Irish debt 250%, Greek debt 310%, and American government debt 358%. I don't have the figure for Japan, but that would also be very high. Lawrence Kotlikoff, Professor of Economics at Boston University, argued in a recent Bloomberg article that, quote, the US is bankrupt. He quotes another IMF paper from July this year, which notes that, quote, the US fiscal gap associated with today's federal fiscal policy is huge for plausible discount rates. Closing the fiscal gap requires a permanent annual fiscal adjustment equal to about 14% of US GDP, unquote. Professor Kotlikoff puts that in perspective by noting that current US federal revenue totals about 15% of US GDP. So that a 14% adjustment would require a permanent doubling of the total tax take. 2 months ago, Jürgen Ostrom-Müller, a visiting senior research fellow at the Institute of Southeast Asian Studies in Singapore, argued that it is likely that before 2020, quote, the US will default on its sovereign debt, unquote. He defended this apparently preposterous statement by arguing that, quote, the US cannot and will not accept the constraints on economic policy imposed by the burden of debt servicing. In choosing between honouring its commitments and respecting the rules of the game on the one hand, or stimulating the US economy on the other, the second option will prevail. So to summarise this part of my lecture, economies of the developed countries are coming out of the global financial crisis growing only slowly, with large fiscal deficits and very high accumulated government debt. This is beginning to raise serious questions about the ability of even highly rated countries to service that debt. What about the prospects for growth over the next few years? Surely the combination of extremely easy monetary policy and very large fiscal deficits will lead to strong growth soon. If not this year, then surely next. I am clearly in the camp of those who believe that the developed economies of the world face a prolonged period of very sluggish growth, punctuated from time to time by further recessions. This is partly because it seems inevitable that the governments of several major developed countries now have no alternative than to embark on a program to get their fiscal positions under control. Several of the smaller European countries, such as Greece and Ireland, have already embarked on aggressive belt-tightening programs. The UK has begun such a program and signalled their intention to go much further over the next 12 months. Germany has written fiscal austerity into its constitution, and it seems likely that the US and Japan will eventually have to at least make some attempt at moving their fiscal positions towards balance. At very least, large-scale existing indebtedness and increasing signs that the public is becoming wary of that debt, especially in the US, mean that there's little likelihood of further stimulus packages. The financial institutions in many developed countries are also still relatively fragile. They are clearly in a better position than they were at the height of the financial crisis, but many of them are in no mood to lend on any but the lowest risk commercial ventures. They are being obliged by regulators to increase their ratio of capital to assets and to fund a higher proportion of their total assets from retail and term deposits, reducing their dependence on more volatile money market funding. Last year, Mervyn King, the Governor of the Bank of England, noted that, quote, for the major UK banks, almost 25% of customer loans are now funded by short-term borrowing in wholesale markets. At the turn of the new century, it was close to zero, unquote. Regulators have made it clear they want banks to be much less reliant on that kind of funding. And of course, it's not just the banks being reluctant to lend. Many bank customers are reluctant to borrow. People who assumed that real estate prices always go up have had a nasty shock. people who assumed that share prices always go up have had a nasty shock. Businesses which assumed that sales would grow every year have had a nasty shock. The animal spirits which drove the strong increase in credit over the years prior to the crisis have entirely gone. In a very important paper presented to the annual conference of central bankers in Jackson Hole, Wyoming at the end of August, Carmen Reinhardt and her husband examined the behaviour of real GDP, unemployment, inflation, bank credit, and real estate prices in the 21-year window surrounding selected adverse shocks to the global economy and to specific countries. They presented evidence that the decade of relative prosperity prior to a shock was typically fueled by an expansion of credit and rising leverage that spans about 10 years, and was typically followed by a lengthy period of retrenchment that lasts almost as long as the credit surge which preceded it. And intuitively, that surely sounds right. Worryingly, in many developed countries, the decade which preceded the most recent crisis saw an enormous expansion in credit, to the point where the ratio of credit to household income, or to GDP, reached quite unprecedented levels in some countries. Slow growth seems the best that can be expected in most developed countries. Well, perhaps China can be the locomotive of the world economy. Certainly I've seen no commentator suggest that China is about to stop growing, but increasingly commentators are suggesting that Chinese growth will slow over the next few years. Some people worry that Chinese residential property prices exhibit all the characteristics of an asset bubble, indeed a very greatly inflated bubble which could pop at any time. Others have expressed concern that a very large amount of investment in China has been in wasteful areas. Commercial property and infrastructure are often mentioned. Some worry about the strength of the Chinese banking system, facing the prospect of very substantial loan losses on much of the enormous expansion of credit which has occurred over the last year or two. Still others note that total public sector debt in China, the debt of both the central government and of local authority enterprises, is probably close to 90% of Chinese GDP, a level which creates less flexibility for the Chinese authorities than is sometimes assumed. Much of China's growth in the past has been pulled along by very rapid growth in exports, and with the developed world likely to grow much more slowly over the years ahead, that doesn't seem like a likely source of high growth. A study by the China desk of Deutsche Bank in mid-September suggested that China's GDP would grow at an average of 7% annually over the next decade, as compared to an average of 10% annually over the past decade. For any other country, growth of 7% per annum would be spectacular.